Thank you very much, ladies and gentlemen, for joining us today, this evening. We see around 85 participants joined in so far. Thank you very much for taking time out, and I'm sure all of you are enjoying the content which is being delivered to you as well. So, if I have to very quickly, in a matter of a few seconds, ask for some feedback about how has the learning been so far, quote unquote, and the trainer, Mr. Jawad, and I, we were discussing how important, again, quote unquote, learning is for professionals. So, let's begin today's session from this particular topic. And how has your learning been so far when you're talking about the BFSI training, the Powerhouse Series? So, if you can very quickly type some comments in the chat box, in the questions box rather, I'll just read a few out and then we will introduce the new speaker we have with us today and a bit about the topic also before we formally begin today's session. So I am looking at the questions dialog box. If all of you can hear me loud and clear, if you can just in a couple of words share some feedback. All right, we have already received a response from Farhan Shahid, and Farhan has said that I'm having a knowledgeable time here. All right, excellent. So knowledgeable, knowledge sharing, that's one keyword taken. Um, Others, informative session. Thank you, Faizan. It's a good experience learning new things. Aaron Salim, thank you, Aaron. Great sessions, very informative. Shehriar Mehdi, very informative session. Sohail Noor as well. Thank you very much for sharing these contents. Um, okay, I think more people are writing, but as they're writing, I'll also just state it here. We're very actively looking at the participation in these sessions, and so far we have about 830 registrations. We're trying to keep the content very, very sort of up to the mark, quality wise, crisp, and bang on the subject: banking, financial services, and insurance. And a little while ago, I was talking to Mr. Jawad that this content is such that it will make its way to the ACCA's learning management system. So our LMS, which is globally deployed across the world, this content is found so relevant that it is going to go to the learning management system, and this model and the content that we are using will then be replicated in other ACCA markets as well. But the trend has been the trend has been set here. Pakistan is the first market where this content is being rolled out. So thank you very much. And in the meanwhile, I've received other responses as well. I'll just try and read them out as well very quickly. So Akhlaq Ahmad has said, excellent initiative by ACCA, which enhance our knowledge within the sector. Thank you very much, Akhlaq. On that point, I would like to make a highlight that ACCA is now becoming very active on, on making communities of members based on their working areas. So for example, banking financial services is one, public sector is another one, practicing members is another one. So we are making smaller communities of members and delivering them content based on the needs of their industry. So that's the whole thought. And thank you very much, Akhlaq, for bringing this up as well. Saim has written that I enjoyed the previous session where they conveyed the importance of psychology within economics and how it affects trends and investments. Fantastic. I would want to go back and listen to that part as well. Muhammad Umair Masood, informative sessions, good insights. However, some content, especially on AML and CFT, was quite basic. Thank you very much. That's genuine feedback. We really appreciate it. We are keeping the content at a level at the moment where it is easily digestible to most of the members. Some people who are already at an advanced stage of learning, they might find the content a little basic, but if that is the case, please let us know, and we'll try to hold subsequent sessions on those subjects which are pitched at a detailed level. So thank you very much. That's very relevant feedback. Muhammad Umair Masood was the person who gave that feedback. Muhammad Ijaz, valuable learning, much needed sectors are being addressed. Thank you. That's what I wanted to see as well. Klein is saying very informative and excellent effort from ACCS side. Thank you. And Akib Nuhullah, I know Akib from many other sessions before, 6 digits and 7 digits. Assalamu alaikum. All right, you're welcoming me to the session. Thank you very much, all of you. So today, the discussion that we're going to do is around investment analysis and appraisals in the financial markets. So I think this is a very, very important subject when it comes to the banking and financial services sector. Wealth management, investment analysis, keeping a tab on all types of financial markets. I think that should be a forte of financial advisors and qualified accountants equally. So our trainer for today is Mr. Jawad Shamim. He is a CFA and also he's a member of ACCA. Jawad has been an active part of the capital markets for a decade. You don't look that old, Jawad, but 10 years, I think that's fantastic. I think that's a lot of experience. With equity research being his key forte, right? Equity research it is. He has been instrumental in supporting various local and global fund management teams in identification of alpha calls for their portfolios. Okay. Throughout his career, he's remained associated with renowned institutions of financial markets in Pakistan. And prior to joining Al Falah, he was leading the research division of EFG Hermes Pakistan, local arm of EFG Hermes, one of the leading brokerage research and corporate finance houses across Middle East and North Africa, if I've taken that right. So, and Jawad, like I said, is an ACCA member as well. So without any further ado, I will hand over to Jawad, and I'm sure you're going to enjoy the learning with him. Again, please keep the session interactive. Please keep putting questions into the questions dialog box. And I'm sure Jawad is going to take session breaks in between the session to take questions from the audience as well. Okay, so to keep it interactive. Thank you very much, Jawad, and over to you.
Thank you, Harun. Just wanted to confirm, can you see my screen?
Yes, we can see your screen and we can see your video both.
Okay, I'll just bring down my video.
And your video is probably hiding behind your screen, your slides, and it'll stay that way because you're the presenter.
So it is okay, right? Or do I switch it off?
It's okay. No,
Great.
it's okay. Just leave it on and just continue flipping your slides. The participants are able to.
Great. Assalamu alaikum, everyone, and thank you, Harun, for that introduction. And really happy to listen the way this whole initiative has been taken, especially the way it becomes part of the our education material for all the members. That is quite welcoming and something that should be appreciated. As you've discussed about the experience I have. This topic, this whole this subject is quite close to my heart. As discussed, this I've been into the capital markets throughout my career, so this is something that is where I've been brought up. So without taking much time on this front, I'll just point out two things there. Firstly, I'll try to keep presentation brief to an extent so that we have more question and answers, and that is something that we're going to keep this whole session interactive. And as one of the attendees mentioned that at certain levels these courses kind of look basics, but I think that was well answered by Harun, that we're trying to take care of the audience from the initial stage, but at the end of the day, if you've got any questions, we were happy to answer, and you can reach out to us, and even during this session we were ready for it. So I'll just start with the basics, that we say what exactly are financial markets and what are types. So I think that is, I would, if you ask me, this is probably the most important slide that kind of tells you what exactly we're going to discuss today. What exactly is a financial markets and the types that we probably, don't even know we kind of interact on a daily basis. But there's a lot that, comes in the ambit of financial markets. I went through various definitions that could help us understand, but probably these are the basics that kind of help us to really get an idea what exactly these financial markets are. I mean, if you define it, financial market is a marketplace that provides an avenue for sale and purchase of assets. So you've got assets, you need to have a place where you value the asset, where you buy it, you sell it, and it all depends on what exactly your need is. As you read in the third bullet, I mean, if you think about it, it's the actual allocation of money within the industry. So if there is an investor who has money but does not have projects or business to put money in, financial market is the solution where it gives you an option based on your risk appetite, based on your horizon, investment horizon, what exactly you want to invest into, which business you want to go into, which type of instrument you want to go into, is what a basic financial market would do. And an efficient financial market would be where these things are easy to do. There are two ways that are very common. That's how things operate. One is the your exchanges, which are mostly regulated, and the other ones are OTC markets, that we say the over the counter. So the only difference, the basic difference, I would say, is an exchange is a public place where you will see things being traded, active rates there. They are there for any investor to look into. On the other side, OTC mostly happens with bond market, money market in Pakistan. Government being the largest borrower, all of the borrowing, the PIBs, the short-term T-bills, all of them are traded through OTC markets. You don't have an active rate on a window or on a screen. So that it's a one-on-one this trade that happens, and that is a very big portion of the way trade takes place in our country and globally. And when you speak of types of market, I mean, when we used to study, when we were students back then, these were the markets that we used to discuss: the stock market, bond market, money market, commodities, derivatives, forex. The addition that has come through, and which has garnered the most interest, I would say, in recent times, is cryptos. And even that too, it's a market, falls into the ambit of financial market. But these are the basic markets that most of us are aware of. And if you think about it, if you follow the third bullet of this slide, all of the markets in another way, or different ways, kind of gives you those type of liberties that are being discussed up. As far as participants are concerned, I mean, it's if you think about it, there are investors. They can be in different shapes, individuals, corporations, then government itself. As I mentioned a few minutes ago, that in Pakistan, government is the largest borrower. So there's an active market. Government puts out its fiscal needs, goes to the market, borrow from the potential investors, and then the trade is done. You've got people who look for arbitrage opportunities, and then when it comes to the intermediaries, this is something, these are the functions, I would say, or those ingredients of the market who kind of help the other players. So mutual funds, hedge funds are the ones who kind of take your money, you give your money to them, and they invest it for your side. Brokers, exchange, and dealers are the ones who actually help you through it, channel the whole trade and investment process. Commercial investment bank becomes a part of arranging capital for a certain part of the economy. So those who need money, they'll bring them closer to the ones who are happy to lend it out. As far as insurance company is concerned, I'm sure a lot of us are aware of it, that these are the companies which kind of give you that protection against an unforeseen event, and then also help you with your life planning going forward. As you look into the participants, then is when you realize that what could be their objectives. And as I've mentioned, this list, if you think about it, it's never going to end, because there's so much that could be a use of any investor. For someone sitting here, purpose of reaching to the capital market could be making money, for others could be borrow money. So if you think, if you look at this slide, you've got a list of factors or the reason as to why exactly someone would go into financial markets. It could be saving money, borrowing, raising capital, and manage risk. This is something that we will discuss it later as well. But as I spoke of insurance companies, so that's where you, and it's a very relatable example. I mean, if you take an example of a car that which one we buy, so there's a leasing process that happens, but then there's an insurance instrument that happens. So you don't want to take that risk, but there's a small amount that you pay. That's something which is similar to the concept of derivatives, that you invest a certain very small amount of money, but that helps you with a bigger potential provision that can come through going forward. Risk, I mean, this is something that is key of everything. I mean, this is something that we've learned from our educational time, that you can never, eliminate risk. The only way you can do it is you can mitigate it, you can bring it down. But there's a big category of risk that every investor, every individual comes through in a daily business. And these are the main categories where different profession, different studies have categorized risk into. We've got market risk, credit risk, liquidity risk, operational risk, and legal risk. I've got a one liners to it. But market risk is as simple as, you buy something for 5 rupees, there is a risk for it going to 10 or coming back to 1. So that's where the market risk is. Probably asset has nothing to do with it, but overall macros aren't in your favor. Something, regulations have changed for the market. So the market risk showed up where your asset value was suffered because of that event that happened. If you think about the other one, credit risk, that's pretty different. It's where it has nothing to do with the market, but the exposure you had, be it equity, debt, or whatever it is, the counterparty that was supposed to give you money, or the counterparty that you put your money on and in, kind of defaulted or has suffered a loss where they aren't able to pay you back. And we all are aware of those limited liability concept, that you can't go to a personal level. There's a certain degree where you can go and challenge it, but if the company goes bankrupt, there's no way that that money is coming out. Third is liquidity risk. This is something when I used to study, I always had a slight uh, question about this risk. But being in portfolio management, I've realized how big risk this is. So when you speak of equities, when you speak of debt market, there are TFCs issued by few institutions. There are few stocks that you are completely sold out when you think about the thesis, when you look at the exposure, when you look at the potential return that can come out of it. It looks a fantastic instrument. But liquidity risk is something that can impair the entire story. If you are able to buy something, and then if you cannot sell it readily, I mean, it's okay if I hold it for 6 months, 12 months time period. But if the market for that asset is not liquid, this is something that's gonna always come back to haunt you. I mean, we're aware of the auto market in Pakistan. So there's a few cars which we declare them as hard cash. So you can actually sell a car within few hours just because of the fact that they're liquid assets. So this risk becomes big because of the fact that there have been positions where if a liquidity showed up, you have to meet that liquidity, you have to dissolve an asset, and that is where a potential buyer is gonna take advantage of your vulnerability and gonna charge you that liquidity premium. So this is one risk which is actually something that worries us, and this is an important risk that is kept in mind in every potential investment decision we as fund managers do. Because as it said, it's just not getting into an investment and putting your money into it. You need to have a escape plan out of it too. Then there is operational risk. A lot of we've studied a lot in past. We've studied about Enron case, Lehman Brothers. There were corporate governance issues. There were financial frauds that have happened. That is one thing that can bring your investment out. And the last one, legal risk, is something similar to it, but it kind of more does with the overall regulatory framework rather than just company specific. As far as managing financial risk is concerned, as I said, completely coming out of risk is unlikely. So there are ways where you mitigate it, and diversification is something that tops the chart that we've been hearing from what childhood, what putting all your eggs in one basket. So that is something that is an applicable concept, that's very practical. That's exactly what we do. We try to diversify within the asset class. Within the asset class, we try to diversify into different companies, different exposures, just so that if there is a problem in one of a subcategory of an asset, your overall portfolio does not suffer on that front. The other one is hedging. I mean, this comes at a very lower cost when you put into its perspective. I'll keep it very simple. What we see usually is derivatives that come through. What it does is you buy an asset and then you create a contra position at a very small cost. For example, if I am say long in a stock, I've bought a stock. What is the risk that I have? My risk is that this stock price can come down significantly. What I can do is I can buy an option on that share, which allows me to sell at a selling price regardless of whatever happened, and it always usually comes mostly comes with a time frame. So what I can do is I buy $100 worth of a particular stock, and at the same time say $5 of derivative on a contra position. So if things go bad against my initial planning, I'll always have another position that kind of keeps me covered when it comes to when position does not work the way I wanted to do it. Insurance, this is probably the most relatable concept we have, that you always have a protection that you can buy regardless of whichever financial losses are. So that is a position that helps you to see through any potential provision that can come through your way. The other three, I would still think is kind of a concept of financial risk. I mean, the first one, the quantitative analysis, something that we kind of study different models that you can run. You can predict the risk of an instrument, try to put in data and get a feel as to what exactly this company can do. So there are a lot of quantitative analysis, risk measures, VAR, and value at risk, and a lot of other measures that can be done. But for me, fundamental and technical analysis is also a part of managing a financial risk. In direct terms, no. But if I have to put my money in, and if I'm performing fundamental analysis on a particular stock or a particular instrument, knowing about it itself is a measure that you can take to manage or bring down your financial risk. So if there are clear warnings in a publicly available data for that company, and those who follow technical analysis who are okay with it, so if there are clear signs, then this itself kind of helps you in managing financial risk, where you can either delay your position or at the end of the day completely leave the position. One more important topic that we do on a we come across on a daily basis is marketing of these financial services. So there's a lot, and when you think about it, when we talk about money being involved and something that is an integral part of the economy, regulators are more active, and in past there have been instances where the weaker regulations were exploited, and there have been situations in past where unfortunately members of financial industries were involved in practices which eventually hurt a certain portion of the economy, and at the worst a bigger portion of the economy. So if something that is so dear or so important to the economy that you cannot forgo or just let go, marketing becomes a challenge as well. And it's good to see the way in recent past the regulators have increased their scrutiny when it comes to looking into how things are marketed. And one reservation that I'll just put forward, there's still that a lot needs to be done on this front, because if you compare it to a basic product, be it a an FMCG product, the customer knows it, what exactly the product is. I mean, if it's an FMCG product, he's aware what he is buying. But if there's an electrical appliance, there's a possibility he won't know the technical side of it, but use of it, what exactly it is, he'll be aware of it. Financial market is where the general public brings in money, gives it to professionals to manage for them, which is why this whole marketing process becomes something that should be really concerned of. And this is where brands focus on, developing trust in consumers. And what I've seen in my experience, throughout, associated with the capital markets, you build trust regardless if your returns are slightly up and down. But if your trust is there in your consumers, your customers, they're never going away, because they know that how kind of technical this overall industry is. If you're able to build that trust, you're able to get it done, then it should be something that will eventually help you. The last one is very important, which I just discussed a minute ago, is marketing should not be deceptive. And I mean, I just share an incident where my friend, my someone in my social circle came to me and told me, there's a bank that is giving you 18, 19% return. And there's an ad there where there's a big number written, 19%, and then there's a very small line at the end which tells you the different complication of that investment. So this is something that is continuously brought to regulators, has been addressed to a very large extent, but this stays a problem within the financial industries, and this is something that I hope, on going forward this will be addressed. But this is probably one area where a lot has been done. But as I said, this is a product where your audience knows much less, makes it kind of skeptical to overall fraudulent activities that can come through. There's also a concept when it comes to, this whole financial markets management, accounting, and for financial services. And this is what how I put it in is, there is one component where you manage the assets, where you try to deliver returns. At the same time, there is an accounting that has to be made as to how the returns were generated. I did generate a return, but would have been better if I would have put it in other asset class. So there are different methods, there are different formulas that over years, we've learned, we've tried to understand, was it worth taking the risk? Just giving an example. So there's the whole process that goes through, and every company, every AMC, I have been working in AMC back in brokerage house as well. There are divisions where we've got employees there who continuously tell you whether it was worth taking that extra piece of risk. Was it worth putting your money in a particular asset? Where could have things been better? So it's just not about generating returns. It is also looking at a broader scale. Was that investment worth it at the end of the day? Was the risk worth it? So there's a lot that comes into which becomes an integral part of the overall financial markets. Now, as I discussed during the risk, fundamental analysis, as Harun mentioned, this is something that my career has been associated with. I've been a sell side analyst for most of my career, and this is something that I've done. This is something that I keep on telling everybody who I meet in my circle. It has, not only has to do with your qualification or what profession you are to. It's just a very basic concept that if you are putting your money into an asset, knowing about it, how it is generating money, what is the thought process behind it, is there a future to that thing what that company is selling to me? It's just understanding about it. So if you think of it, fundamental analysis, while one would say, this is a big word, there's a lot that happens, and it definitely does. When we speak of financial models, when we speak of putting the macro, combining it with micros, and coming up with an evaluation and conclusion of an investment. My point always there is, if you speak of the second bullet on this slide, it can be top down and bottom up. So if there's a product that I've showed up in your market, in your, say, any supermarket, and if you see that number picking up, there's a high possibility that that particular company is making money, or there's something new in the business that have come in. So on a very basics, it is something that everybody can have an idea of. If somebody today is selling me, say, I would say there's a company, let's say, just to give you an very simple example, they come and sell you cassettes that we used to use 20 years ago. Every, I mean, it's a very normal take on it. One would say that, this business is out now, it's part of past now. So if somebody tells you that this business is gonna, flourish, there's a lot to do it, there's an immediate answer to it that no, that's not possible. So that is where I would say fundamental analysis start. The more you question, the more you think about an investment, that's where, in essence, fundamental analysis start. But as we've seen over years, a lot of information is mandatory to be made public. So you've got annual accounts, you've got quarterly reports. In a lot of cases, you've got monthly data coming in. So putting that into the picture before putting your money in, making your investment in, it all comes under the umbrella of fundamental analysis. And it's a very common jargon that happens, that is used in our industry, is top down and bottom up. Top down is as simple as, the way things have happened in Pakistan in recently, the commodity cycle, the way dollar has shot up. There is a top down approach where people have a kind of a negative view on the overall investment cycle of Pakistan. So a lot of you would have heard in news. We can discuss it later if a question, if any question comes up on it. There was a news that would be shared daily, was with regards to yields on the international Pakistani bonds has shot up. So they went from in the range of 8 to 10 or 12%, and they shot up to more than around 50% in different tenures. So that was a top-down approach. So the investors sitting outside had a negative view on Pakistan because Pakistan was unable to secure IMF deal back then. Commodity oil prices were soaring, so there was a lot of pressure on the external front. So that was a basic top-down approach that an investor sitting out of Pakistan took on Pakistan, which eventually took the yields up. Similarly, what happened when IMF came in, dollar inflows started to come in, we saw that yield coming down. There was a change of view from a top-down approach. As far as bottom up is concerned, you're sitting in Pakistan, you're looking at equity markets, debt markets. There's a bond I want to put my money in. There are two, company A, company B, and I'll be like, company B has got solid financials. They won't be having any issue with regards to paying their numbers. And when I look at the rates, they kind of look similar to me. Then I go with company B and put my money there. Then the third thing that comes, as you would have heard with regards to financial modeling, as I said, you have got public data available. When you study the businesses, you have an opportunity to forecast what exactly this company can make. If a company is earning 10 billion today, is there a possibility of this company, doubling this earnings over 5 years? And that is where you try to make, this is the so-called financial models, where you bring in most of the things you can on an Excel sheet and try to forecast what exactly an earning this company can report. And based on it, you can then decide whether to invest in it or not. And as I said, when we speak of top down, regardless of how good a company or an investment is, macroeconomic factors is the basic that kind of sets the entire tone of an investment. So you would have heard, a lot of would be aware, the way State Bank has increased rates. So it's a macro factor regardless of how good your business is. State Bank on a tightening spree, State Bank and government indicating that they're putting in their efforts to curb consumption, regardless of how good auto manufacturer you are. Just for example, if government and the macroeconomic conditions are in a shape where you will have pressure on your sales, there's no other way, because see, at the end of the day, you're gonna sell in Pakistan, right? So which is why macroeconomic, and this is a very important factor, because in a lot of situation what happens with bottom up, you get so tied up in the micros that you end up losing sight of the macros. And this has happened over and over and over and over again, why we have seen these boom and bust cycles, where when it's a bullish trend, a bullish spree, people tend to forget what's happening on a macro level. Very relatable event is 2017, that backs to our market was going up, people were way to bottom up, and what happened, they lost sight of the overall economy, where current account deficit was ballooning, our debt profile wasn't pretty, that was getting uglier day by day. And that's exactly what happened. We saw that 53,000 peak, and the way the market came down, it was just because of the fact that even more learned people, or the one who have been associated with the market for years, lost the sight of the overall macro picture. The other analysis is technicals. I'm sure the way cryptos, the way stocks have gained popularity in recent times, number one. Number two, the way social media is used. These are charts that most of us are aware of, that come to us in different shapes. And it's just another form of analysis, which is not as thorough as fundamental analysis. You don't go into the detail of companies. It has more to do with price and volume. So regardless of whatever the name of a company is, there is an asset which has a pricing data and a volume data. A technical analyst would look for trends in its pricing, and based on it try to forecast what exactly a price could be. So I just took two random pictures, where this is a simple chart, where these are candlestick charts, and these are plotted over a time period. And on the right front, it's a candlestick chart which has Bollinger Bands, a different various approaches where you try to identify the trends and then look for patterns if there are. Then on basis of it, you try to forecast a price of that asset. If you think of it, as we discussed, this is applicable for those assets only which are traded liquid. If there's an active market for it, it's impossible for you to use this data for, say, an OTC instrument, or for an instrument that is on exchange but is fairly illiquid. So you don't have sufficient data where you can look for trends and charts that could help you. So that is it from my side with regards to the presentation. Uh, we can open the floor for Q&A if that works.
Thank you very much, Java. And let's hear from the participants if they have any questions. So over to you, participants. We're looking at the questions dialog box. If you have any questions to begin with, let's have a look. I will also be happy to unmute participants who would want to verbally put up their questions. So as a past practice, you may be able to raise your hand and I will then see how you can be unmuted. We have Syed Farouk already. Syed Farouk, would you, and Muhammad Awais. So let's hear from Muhammad Awais first. Awais, I'm going to unmute you. Please unmute yourself now and you can then speak. And in the meanwhile, those who wanted to type in their questions in the questions dialog box, please go ahead and do so. Muhammad Awais, you have been unmuted. Please unmute the orange microphone button. Click it so that we should be able to hear you. Yes, I've seen that you are unmuted and you can speak.
Assalamu alaikum.
Walaikum salam.
Acha sir, can you explain please what is CDO, collateralized debt obligation? Because normally it is a concept that basically CDO are the main is a product which was the responsible for the financial crisis in the United States.
Did you get the question, Jawad?
I did get CDO, right?
Yes, yes, CDO, collateralized
Yes.
debt
All right,
obligation.
sure. So basically, what happens is a concept that comes in our financial markets is basically it's actually, I would say, an intermediary product that comes through. What happens is there, if you go to the very basics of it, what happens there is a debt instrument that happens. So there's a debt instrument where you've got a potential lender to you, and then there's someone who issued it. What happens in CDOs is that it's a semi product where you've got a series of obligations in debt nature, which are kind of coupled, brought into a single product, and that bucket is sold to the investors. So if you think about it, there is one investor here, and this is the asset. There's a bridge in between that comes, and what happens is that you package it in a way which where you give that exposure to the final investor. What happened was in financial markets, as I said, bringing the investor and the investee closer, there are different ways in between. You come with different shapes and product that help you with it. What happened there is any asset backed security or a collateral backed security. What happens that in asset backed, what I would do, I've done lending and there is an asset to it. In this case, you have just add an intermediary between the one who have got the money and who is obligated to pay it. So what happened in the US, or what we've seen in history, is there was a bucket of obligations, not an asset. Itself was mortgage finance. So the one that is pretty famous in our financial history is that those mortgage loans were compiled together, packaged in a single product, and those buckets were sold to the lenders. So lender didn't know that who exactly is the one who have took the money, but there was an intermediary that came in. And if you think of it, if I'm taking a direct exposure to a product, there is different ways I'm gonna make money on it. I'm aware of the person I'm giving my money. There's a spread that I'm earning. Here what is happening is you're speaking of a bigger investment, then they've been clubbed into one, and then they've been sold to a spread. What happens is that a very close eye needs to be put into the fact that has fundamentals on that collateral side changed or not. So what happened was that the fundamentals in a macro recession kind of wavered, moved the other way. And till the time the ones who were putting their money in, trying to diversify their exposure, trying to, earn that extra money, they, as I said, kind of lost the sight of the overall risk that was happening or deteriorating the overall fiscal health of that particular collateral class. So that as it's just a deck of cards, as soon as one falls in, that collateral was hurt, and that eventually hurt the intermediary asset that was linking the investor and the collateral.
Thank you very much. More questions. So there is a question from Muhammad Amir Ramadan. He's saying weak currency pegged to a strong one to maintain stability in the market. Is it good or not?
Weak currency pegged to
Pegged to a stronger currency to maintain stability in the market.
see, I'll keep it very simple, and it's a very simple concept if you think of it. What exactly does impact your currency? What is value of your currency? So it's as simple as, if you look into our homes, if we have a strong income that is coming in, and there's a certain expenditures that I'm able to meet from what I'm earning, I'm good to go. But what happens is then that my needs start to increase. There are a lot of expenditures that I have to done for which I'm unable to satisfy it myself. I borrow money from different places. I borrow from different classes, and which kind of impairs or brings pain to my balance sheet. That is what happens with the country. Pakistan exports something. Pakistan is able to meet few of its need internally, but then there's a lot that has to come from outside. if your net position is something that is a difficult one to maintain for a country like ours in Pakistan, the dollar earning streams for country is less. I mean, when you've heard about current account deficits, your remittances, your exports club together and bring in FDIs as well, not a big number in our case, is continuously lower on is lower against this imports. You will always have that extra need of that foreign currency to balance your balance sheet. When you say of pegging your currency, it's very simple that to maintain a peg, there has to be a continuous pumping of money into the market. If state bank if a central bank goes for pegging its currency, that peg will break on a regular basis. For that, you will have to supply a certain number of that foreign currency to ensure that in a free market or in that controlled market, your currency is pegged to it. For a country like ours versus a country, I mean, if you look into the MENA, where you see Saudi, where you look UAE, you've got a strong external position. You've got oil as major exports. So on an external front, you have that power, you have that liberty of borrowing the dollars, of lending the dollars, where you can net your positions. A country that we have, our debt to GDP ratio is still less. It's a surprising fact, but if you look in the actual terms, the country is actually, has borrowed a $130 billion of loans. So when you put that thing in perspective, it looks nice, it brings stability, and it actually also helps you with FDI and FPIs, where foreigners can bring their money in because they have that relaxation or comfort that they're not going to lose on the currency side. But as far as its practical terms is concerned, this is something that a country like ours can actually not afford it. So it's good to have your currency pegged to a stronger one, but maintaining it is something similar that we've seen historically, where our dollar market, PKR market, was in a free market. We've seen that in 2014-15 era, where, think about it, it was kind of pegged there as well. So it you'll always have your central bank pumping in dollars just to maintain that equilibrium. But in the longer run, if your balance sheet is not strong enough, any headwind that come your way, there's the repercussions are gonna be much bigger than it would have been on a normal day.
Thank you very much, Jawad. And while we have another question from Sonam, we are still looking at people who may want to raise their hand. Muhammad Rasil has his hand up, but other people may raise their hand if they want to put up their question verbally. Jawad, in the meanwhile, Sonam is asking for your technical advice, and it's entirely up to you whether you want to share this advice free of cost or not. But she's saying that many thanks for such a great presentation. Since FED rates are increasing and US dollar rate is moving upwards, which dollarized investment options, if any, do we Pakistanis have to gain higher returns as US dollar rate goes up? So entirely your choice whether you want to answer this as technical advice or free of cost.
Harun, thank you so much for reminding me my day job. So we've been doing it a lot. But I mean, it's a very nice question, for a fact that I go back during a time when, we were growing up and we were looking for opportunities. There's a very famous saying that I would always have in my family, where my father would tell me with regards to cars. I've been a fan, so I would always push my father for getting a car, and the immediate answer would be, we have one, don't waste money, it's not worth it. But what economic concept that we forget here was that it's a dollar asset that you have in offering. And if you look at the way these OEMs, these local manufacturers, they're heavily dependent. And all of us are aware, every dollar jump that comes through, the other day you will find an auto assembler telling you that, we have to increase prices because a lot of our costs are dollar based. So this is one asset class, and this is very important because, unfortunately, if you think about it, in Pakistan, there aren't a lot of investment avenues where you can actually park your money in when it comes to dollars. So back then, dollar was a free market, so you would buy dollar directly. Things have changed big way that they were back then. So that is something that is out of the picture. And secondly, currency is not an asset if you think about it. It's not generating you any inflows, or it's just a piece of paper that trades within an economy. So we've seen a lot of things have happened. We've been vulnerable, which is why dollar returns have shot up. But on a broader scale, there are a lot of asset classes that have helped you outperform dollar if you remove this episode that has happened, say in 4 to 5 months. But it's very simple. I'll take back this the one who have asked this question to the slide where I was talking about fundamental analysis. Think of options that you have today that has to do with dollars. So as I mentioned, cars is an investment class. The other one, this is an unfortunate problem with our country, and I really hope this is addressed in some way. You've got your gold market, which is kind of completely deregularized, it's not documented. But most of dollar is imported. The dollar rates impact you, but they are converted through dollar. So there is one hedge. So until and unless dollar kind of collapses tomorrow, sorry, gold collapses tomorrow, you have a ready asset that is available. But the liberty that you lose out there is you don't have the option of being documented. That's second. And I'll come back to that. The market that I operate in, it's equity market. There are a lot of sectors that earn in dollar or benefit from a weakening PKR. So that is where you're going to get the reports. Just for the ease of our audience, there are sectors, for example, technology. What they do is they export services, but their employees are in Pakistan. So their costs stay in Pakistan, their revenue comes in dollars. And then there is one sector, the energy chain. I won't complicate things, but what happens is that their, sorry for that, so that their revenues are dollarized, but unfortunately, the way this whole payment and recovery system works in Pakistan, you end up not making money in. But if I sum it up, the options you have, one stays the autos. Cars and autos in Pakistan are actually not in depreciating asset. And it's sad to say, because when you speak to people outside, it's just because of the currency that happens. So that is one asset class. Then you've got the commodities, but commodities, dollar, silver are very rare commodities, which prices of which don't fluctuate much. So that helps you cover that dollar thing. But my point would be that those companies, as I said, as we discussed in our first slide, capital markets, financial markets give you an opportunity to put your money in those assets which it wasn't easy for you to put your money in. So why not look for companies, look for sectors which have those dollar returns and cost and PKR, which helps you with uh, hedging your exposure to your currency.
Thank you very much. Detailed answer. While more people type in their questions, let me ask a question of you, Jawad. So, I was listening to the finance minister giving an explanation of why is dollar still peaking, even though the IMF tranche is available now. So, I mean, he explained this as a simple demand supply rule, and probably in the face of import restrictions and other restrictions in place, trying to keep the import bill low. He said the demand of the dollar, from the open market is very high, and there's a shortage of dollar as well. And this some element of this price, this dollar price, is speculative also. I'm repeating his exact words. Does that mean that this is still a temporary bubble, and going forward, if the dynamics are fixed, if the supply increases, this bubble will burst and the dollar will bounce back to about 180 rupees to a dollar? Or is it going to be speculative for a longer period of time? Just some expert opinion.
I'll never comment on the exact level of currency. This is something that I've learned during my whole career. See, currency is something that too many moving parts, and this is what I've
Yeah.
learned from my great seniors that I've worked with. Currency has got so many moving parts, and then you've got government coming in influencing the rates. There is never a free dollar market or a foreign currency market. You always have a semi controlled market, or there is, I would say, it's just a seesaw where you allow more towards a free market or a control market. We have seen a control market back in 2015-16 time period. Then we've also seen a
Yeah.
free market during this 2019-20 period. When they say of dollar being hoarded or a supply issue, for sure, yes. So if there is a sentiment in the market, if there is a sentiment that things are difficult, or we have seen the way IMF program not into the picture, your current account deficit ballooning every month, mainly because of commodity prices. So it's, as I said, answering to a question, look at your balance sheet or your income statement of the country. So when you know that the government has more dollars to pay, or there is an a rare pressure that has come through, you will always find a simple, that as the FM mentioned, a very simple concept of demand and supply, and then secondly, people will start to hoard further. Second point that we have been told about, or we see on a daily life, and I mean, the government was also asked to address in the FATF, was documenting this currency and these gold trade. So there's a lot of foreign currency trade that happens openly without documentation. So today, while we know that the people have dollars, you don't have the actual size or the actual holding of it. So when I'm told that government is going towards dollar curbing spree, you aren't able to. If I have to travel for legit reasons, it's difficult for me to get dollar. There's a simple concept. A friend of mine is gonna come to me and be like, 220 is the rate. I can give you for 225. So there's a supply that has been purposely brought into, has been curbed, and demand, I won't say has shot up. To an extent, yes. When dollar was going up, people were converting their PKRs into dollars just to ensure they're able to get their money in. But winters are coming. That is where these commodity prices will test country to the fullest. We've been having those depleting gas reserves, so a lot of RLNG will come through. If these oil prices don't come down, you'll have those current account deficit pressure, which will keep dollar on the higher end. But if we put that out of the picture, the way this money will start to flow in, there will be a correction in PKR for sure, and we're gonna see it back to where it all started. 180, 190, 200, it's just the market dynamics going to happen. But historically, what we have seen in a country like ours, which has a weaker economic situation, especially the external front, it's unlikely that dollar can come to that 180ish level. It's just a price that has been brought into it. Yes, recent spike that have come through, say from 220, 215 to straight 240, that is where that can be addressed if things get into place and we don't see commodity prices playing with us in winters. But if that happens, then you'll be finding new base to your currency. So say 6 months, 8 months ago, 170 was a new base for me. Out of nowhere, 190 became the new base. But if this winters are harsh for us, then probably 220ish could be the new level for us. But if oil prices stay where they are and there's not much pressure, as soon as things start to relax a bit, you'll find a strong correction. And the one we saw where dollar went as high as 45 to 50, but then there were people getting dollar being traded freely at 215. So there's a correction that came in just because of speculators coming into the play. So there is a high possibility that if things are smooth, I'll go with what FM says. But I hope winters aren't harsh as they were previously.
Right. Thank you very much. Thank you for a very detailed answer. And although we have gone on a tangent to the actual topic, which was investment analysis and appraisals and financial markets, we are on currency and monetary policy at the moment. So we have a question from Sonam once again, and she's saying recently Pakistan has received funds from IMF, which improved our forex reserves. What are your thoughts on our debt obligations and dollar outflows after 1 year when we will have to pay interest in our debt? How do you see Pakistan's liquidity position then?
See, every year we walk into, every year we get the budget in our hand. It's a very tight position that we have in front of us. So, as you see, our country has an inherent current account deficit. So, you import oil, there's a lot that is being imported. So, there's a trade deficit that mostly shows up. So, there is not an incremental dollar that comes there. So, what is the other avenue that will generate dollars for you? There isn't any. So I mean, if you see, if remittances come up as a positive surprise, that is where you can generate those extra dollars. But if you speak of it, the number that finance minister came was around 33 to 35 billion dollars for the next year, and most of our requirements are rolled over. So sitting where I am today, if you are into the IMF program, you picture in those Paris Club, multilateral, bilateral inflows, you will be able to see through the day. So you will be able to meet those requirements, and those will be mostly done just by roll forwarding those loans. And as far as at a point in time where your interest payment start to become an issue, Sukuk international bond market is where you bring in, because that component is still low if you look at the debt profile of the country. So if you speak of numbers where we are sitting right now, there could be slight difficulty for the country at the end, but the way things have been dealt with in recent past, rollover is the option that's going to come, that is going to be used. If you speak of incremental dollar inflows, that's not the case as of now what we have.
Thank you. And Sonam, I hope you would have received the answer to your question. Okay, so we're looking for questions once again, and if we have more questions, you can put up now. Otherwise, I think we call it an evening. I think very knowledgeable so far, thought-provoking. So just, all right, we have a question from Umair Ahmed, and I think it's now going to become a little political more than economics. But the question is, the previous government had offered turf, which was utilized by almost every industry to import machinery. I remember this was the case for textile, mostly when there was a textile. It seems that the current situation will be a new normal for Pakistan. What are your thoughts? Yeah, without going political.
I won't. I mean, as long as things go good for Pakistan, I'm happy with it. Not at all.
So,
See, the first part of it, a great initiative, but unfortunately, put in place the wrong way. I mean, it was a great initiative. This should have happened 5, 10, 15, 20 years ago, but never too late. But the way it was rolled out, the way it was given, that was something that should have not happened. So I am someone who loved the concept. Unfortunately, even today, Pakistan's 60-70% of exports are textiles. So we haven't been able to give, in bring up another industry that could come today and complement textile when it comes to our exports. So 5 years, 10 years, 20 years ago, there should have been economically friendly policies, loan facilities that should have been given to big business groups or even the small ones. But unfortunately, the government and they would have make use of the lens that have and try to explore as much opportunities as possible. So if you think of the basic concept of what was offered, it was great. But the way turf was rolled out is where I have an issue. We have lived through it. What we saw was, I'll give you an example of a sector, cement industry. So there are, I think, 3 or 4 companies, if I'm not wrong. Please, spare me if I get the number wrong. But there are 3 or 4 companies who actually got those turf loans, and those were the companies who had already planned expansion some 6 or 12 months ago before this turf happened. So the point about it is there is a product that the government and the state bank brought in to encourage investments, to encourage business or individuals set up industries. You ended up giving it to the same players for the same products that they were already making, number one, and number two, they already had plans. So Mr. A was setting up cement plant or another plant that was, a widely known industry, had that plan, had the ability to borrow at 10-15%, whatever that rate is, but they got benefit of getting the loan at 5%. So there was an external pressure, the fiscal pressure you put on yourself and obviously on banks. So the state bank was giving that 1 or 2% spread to the banks. But if you think of the overall picture and when you look at it, it had to happen regardless of turf. So while that product was great, the ones who got it, so majority of them should not have got it. What we would have done was bring in new entrepreneurs or those industries that where you think there is potential, but they're not expanding. They're not expanding, and you send your people there, ask them what exactly the issue is, and then that is where those loans should have been provided for. Coming back to the second part, I unfortunately I do agree with what the participant has asked or mentioned here. The way where we are, the way the policies have been, if we don't get a reality check, if we don't look into few of our policies, as he mentioned, we're gonna be in the same position. I'll just make it a more a worrisome statement here. The situation could get worse than where we are. And think about it. I mean, you have been in the industry for a number of years. What we have seen is typically Pakistan has been known as a boom bust cycle market. So, which is why investors don't come in, especially the foreign money. So, there's always a fear of a bust that follows after a few years of boom cycle. The way these policies have been brought in, the way industries have not been set up, debt profile not being managed, what's happening is these cycles are getting shorter now. Previously, it would take 5 years, 6 years for a boom cycle to end and a bust cycle to come in, 2 years, then again 5 years. Now that 5 years or those years of boom is getting shorter day by day. And it's just because of the fact that the balance sheet is getting weaker day by day. You are to get more loans than you were taking, say, 10 years ago. So if this is not addressed, for example, just an example that the turf wasn't used the right way or should have been more productive, these cycles are going to shorten. So previously it was 5 years, it got to 4 years, 3 years, where we are right now. When 2018 government came in, tough decisions were made. There was a macro rebuild that happened for 1.5 years or what. Then COVID came through. It was a time period where a lot of things, you can't judge anybody for it. But then again, 6 months, 6, 7, 8 months good. Then again, we did not follow the policy. And when I say policy, back in August, September 2021, the government focus completely shifted towards chasing growth. So the import channels were open, your import bill started to shot up. So I'll just add to what he said, that things could actually get worse rather than where we are if policies are not made the right way or being considered the right way.
Thank you very much, Jawad. And I mean, the situation is already, started giving me heartburn. If this is not the trough that we have to rebound from, if there is further depletion of economic conditions, God help us. That's what we can say. But let's keep our fingers crossed. I mean, I think all of us as professionals, we should play our part in debating and talking about these matters, in being aware of what these matters actually could mean. I very shortly saw Mahad's hand raised and then she lowered. Mahad, are you interested in asking a question verbally? Shall I unmute you? Are you good? I'm trying to look for Mahad again. Just give me a second. Or otherwise, you can type in your question in the meanwhile. Okay. Okay, so Mahad, if you would want to be unmuted, I can try that now. Can you raise your hand once again, please, if you want to ask a question? Otherwise, we don't have any further questions in the questions dialog box. If anybody else wants to ask a question, we can maybe wait for a few seconds. And if nobody's interested in asking a question, we can then call it an evening. Okay, so I think that's almost it for today. We don't have any further questions from the participants at the moment. If you still have any questions that comes to your mind afterwards, you can send it through email, and you can email it to me or through your GoToWebinar platform, send it across, and we'll run it through Mr. Jawad Shamim, who will, I'm sure, be able to take some time out to respond briefly to your questions. I think with that, we call it an evening. Thank you very much, Jawad, for taking time out, for sparing your time and speaking with our members. I'm sure members would have found the session useful. Please share your feedback once again. I am noting down the feedback that we received earlier in the day, earlier in the session, about about the level of the training. If you want it to be more high end, I think that can be managed, or maybe for future trainings would be arranged in a way that they're more specialized. So I think with that, we come to the end of today's session. Thank you all very much for joining us. Thank you, Jawad, once again, and take care of yourself. Goodbye.
Likewise, thanks everyone.